Let's start. Hello everyone, welcome to this training program. I see we have quite a large number of attendance. I see Afifa here, I see Danish, I see Imran, Jason, Khurram Farooq, Mansoor Kadiri, Macro Simon, and then I see, sorry, Muhammad Ghazali, I see Muhammad Muazzam, Yasir Ahmad. So yeah, I think let's start, guys. Thank you so much for joining this certified training program. I'll give you a little background about myself, my company, and what exactly the purpose of setting up this program. My name is Mohammad Rashid. You can call me Rashid, and I'm the co-founder and CEO of Fimbler. Fimbler is an Fintech ecosystem enabler. We established the idea of setting up this enabler or a platform where we can support Fintech companies, investors, Fintech enthusiasts, students, professionals, and of course there is a quite long list of stakeholders. The initiative we started last year, but we got so much traction and interest from the stakeholders to have some kind of a program in place that enable fintech startups particularly, and those who are interested to set up their own fintech or maybe work for fintech, to have some basic set of skills of this industry. So that's the main purpose and background of setting up this program. I'm not going to take too much time of yours because definitely it's quite a lengthy program. I know this is your weekend. I won't be spending too much time to just chit and chat, and we'll just jump directly to the content. Before I start the presentation, few housekeeping items. I would suggest everyone to stay on mute, and we will definitely give an opportunity to everyone. If there are questions and you want to share your thoughts and views, definitely we will have time for this. But because of the way we structured this training program, we don't want any interruption, because 3 hours training session, and definitely we have quite a lot to discuss. I'm going to share my screen, and if you guys have any trouble, sorry, I see someone is not on mute. So if you have any trouble, just let me know, and definitely we'll try to address your issue as soon as possible. Yeah, so I hope you guys can see my screen. In the meanwhile,
Yes, we can.
Yeah, Danish, I can see Danish as well. So certificate program in Fintech Essentials, it's a certified program. At the end of this 3-hour session, we are going to distribute certificates, and because this is not a in-person or physical session, therefore we won't be able to share physically, but we will be sending your certificates to your email addresses. So I have a small request to every one of the participants to please send your name and email addresses in chat box. This functionality is available. We are going to record this session as well, so we are going to share some updates with you guys at the end of session. As I mentioned, few housekeeping items, few things to remember, because this is a 3 hours online session. Therefore, we have limitations. And the limitations we have is obviously one of the main limitations we have is 3 hours. We won't be able to exceed probably 5, 7, 10 minutes. If everyone is fine, then we can exceed some more time, but not beyond this. The course is designed mainly for beginners, although it's not too beginner. Definitely, you will see some quite a technical stuff there as well. But the idea is to design for beginners who probably is not aware of what this industry is doing and how to progress on this. Time constraint is definitely there. I see Asif Tanveer as well. We cannot do so many exercises. We will because of the model we have. I see someone is not on mute. Yeah. So therefore, it's mainly interactive, definitely, but not too interactive in terms of we won't be able to take so many questions, but definitely we will take some questions from the participants. Uh, I see someone is not on mute. Yasir, I think this is you. Can you please go on mute? Yeah, thank you. We will have six, in fact, different sessions where we are going to take questions, and if you want to share your thoughts, definitely you can. I'm going to very much rely on videos of experts. I'm going to use those videos. So if you have any trouble hearing the sound, definitely do let me know. But these are really good videos, and we are going to use some real life cases as well, use cases. The course outline is, I'm not going to spend too much time. We have organized this whole training session into 6 modules. Module 1 is about just high level introduction of fintech. Then we are going to discuss key technologies that is driving fintech. We are going to discuss fintech business models, regulation and compliance and fintech space, innovation in payments particularly, and definitely we are going to talk about financial inclusion. That is, of course, it's a really important topic. Without this, we cannot discuss fintech. A small before we jump onto the content, I just want to watch this small video, and then once this video is done, we'll have a small discussion about your views on this video. Let me, yeah. Yes, I hope you guys like this video. The reason of sharing this video with you guys is out of the box, the concept of out of the box. Because why fintech? When we talk about fintech, why we always talk about out of the box, how fintech is different from typical financial services. So that's the main idea behind fintech, because what they are doing is based on existing technology, what financial services are offering. But the question is how fintech is different, what exactly they are doing that is considered as out of the box. So that's the main idea behind establishing fintech. And you will see when we are going to discuss the content and topics, you will see, yes, what they are doing, what fintech is doing, although based on the existing platforms and technology, in fact somehow existing models, but what they are doing is out of the box, because the way fintech people think is different. They think differently. I'll give you one example. Yesterday I was watching a video of Chief Operating Officer of Revolut. So he passed a very interesting statement. And the statement he passed is that we do not follow a market benchmark. We are the benchmark. We do not chase a product. We build a product and prove that this product is the right fit for the market. So this is the out of the box fintech mindset. And of course, you will see we are going to discuss this as well. Unfortunately, I cannot share the full screen because I need to add definitely our participant as well. There's quite a long list. First question, what is fintech? The literal meaning is very clear of fintech. Fintech is financial technology. So if we see in the past, I'm sure I know the participants we have, most of them probably, or few of them, you have extensive experience in financial services or corporate world, such as banking or insurance or asset management, and of course different financial service sector. You guys You guys are aware of technology. If I take example of a banking, every bank, they have their core banking systems. So this system, this is a financial technology. So banks, financial institutions, insurance companies, asset management, technology is not new for them. But the concept of fintech emerges few years back, and I'm going to spend some time to see the historical progress of fintech as well. But fintech is straightforward financial technology. But what change this financial technology brought into our lives in the industry, that is really important. If you see the next slide, the evolution of fintech, 90s kids, if I use the term 90s kids, it's a very common idea of discussing who born or raised up in 90s. Credit card initially, we heard first time online banking or credit card in 90s or maybe early 20s. Citibank was first of the bank who introduced credit card and other form of card in the region. So from there, the emergence of fintech started. There is of course a roadmap available. You see, starting from 1990s when electronic banking started or introduced. Then other platforms such as online stock available, online trading. So it's the story. The story started from 1990. Although somehow ATMs are also considered as financial technology, quite old, not too new. But yeah, from there the journey started 1990s. Let's watch a small video. It's a very interesting video about the journey of fintech. Let's finish this video and then we'll talk about the journey once again. Over to you guys. Yes. So if I'm sure you have watched this video, one interesting information, and I'm sure we all got from this video, is year 2000. So year 2000, almost 24 years back. That was the time, by that time, typically financial services and technology companies, they were working not exactly in isolation, but they were working in their specific industry. They were collaborating somehow, one way or another. But year 2000, that was a time from where technology and financial service industry started collaborating. and from where the concept of fintech started or emerged, I would say, although it started years and years and years way back, if you use the history 1800s, but the actual concept of fintech started in 2000 or after year 2000, where technology companies realized that they have so much influence on financial institutions, and they wanted to leverage this influence. What does it mean? It means that financial companies, because most of the financial institutions, they were heavily relying on technology, whether it is your core banking application, whether it is your ATM, whether it is your own online banking, whether it is trading, whether it is checkbook issuance, whether it is card issuance, significant reliance on technology. And these technology companies, when they realize that they are the one who is providing technology to this financial institution, why not become financial institution? So from there, these technology companies, they started becoming a regulated entity. They chose this path. They chose this path to become a regulated entity, and from there a new category of technology, financial technology company emerged, that is called fintech, that plays the role of technology as well as offering services directly to the retail or end user or customer. So fintech before 2000, they were typical technology companies. They were not connected with the end user or customer directly. They were just providing their technology solutions. But post 2000, companies entered into the space of financial services, become regulated, and the regulators also realize and understand post 2000 that this is a new segment, and we need to really focus and spend some more energies and time and resources to build programs and regulations for these companies. So that's how the fintech companies started. Now, right nowadays, if we talk about fintech companies, although it's sometimes it is a buzzword, fintech sometimes considered as buzzword, not anymore, but it's a huge sector, it's a huge industry. When we talk about banking, typically when we talk about banking, we say banking means bank accounts, banking means your online, your funds transfer, banking means your credit lines. These are the typical products. Of course, there are other products as well, but fintech sector is huge. So I have listed few categories of fintech services that are being offered now. The topmost is payment. When you talk about fintech, it's all payment, 70% payment. Whoever talks about fintech, either they are talking about payment institution, or one way or another somehow they are linked with payment. And payment means whether it is your digital wallets or mobile wallets, such as your peer-to-peer payments, transfers. We have example, Apple Pay is of course very good example of your mobile wallets. Google Pay is also a very good example of your mobile wallets. Then PayPal is P2P payments, is a very good example. Although in western part of the world people are using it a lot, but it's a very good example of peer-to-peer payments. Payment gateways, everyone using payment gateways. So these are payment companies, but that's not it. Payments is a really huge sector. If I spend a full day, 24 hours to speak on payment, particularly products, it's too less. We need more time. In banking, of course, banking is there, but there are different type of banking emerged since post 2000. Digital banks, regulators globally now they are issuing only digital only bank license. Wio Bank in UAE, who is people who are operating from UAE, they know Wio Bank very well. Wio Bank is a fully fledged only digital bank. They do not have locations. So this is another definitely very good example. Lending, crowdfunding, I am sure you guys have heard about crowdfunding. This concept was not there. We will discuss crowdfunding a little more detail in subsequent slides. But crowdfunding, Central Bank of UAE, they issued crowdfunding regulation. The concept is new and interesting, where you are not relying on banking. You are not relying on banking. You are not relying on an institution that help you get a loan or approve your loan. It is between peer to peer. For example, I see Danish is there, I see Khurram is there. Myself, Muhammad Rashid, I can just connect with Khurram directly through our application platform, and I can arrange my funding. So this is all crowdfunding. Investment robo advisory. robo advisory is not too new, but who are into investment and fund management, they know if they have particular interest in investment, they really do not need to connect with a wealth advisor. They can just get the information directly from online systems, where robotic algorithms are built in the system, and these systems give you advice very quickly. In fact, it is happening on your chatbots too. Chatbot is also a kind of robo advisory, where no one is sitting behind. You can just type your question, you get the information. This is all fintech, online trading platforms. Insurtech is of course progressing very well. RegTech is another interesting area, and RegTech means, so in the past, regulatory and compliance teams, they were really huge. Big institutions such as banks or insurance companies, they used to have a very big compliance teams, but now you do not need any more. If you need sanction screening, if you need to report STRs or filing SARs, you really do not need a team of 10 or 15 people. You have a RegTech solution available that identify what is the suspicion, that takes a decision as well and give you a final results where you can decide whether to file STR or not. So regulatory technology is there. You really do not need to read all the regulation all the time. It's a regulatory technology that tells you what are the changes happening in the regulation. It gives you exactly change and where to change in your overall platform and your processes. So regulatory technology is progressing very well. Blockchain, crypto, we will definitely discuss in detail. It is everywhere. After Trump, I'm sure you might have heard about the value of Bitcoin is going to reach hopefully by 100,000 US dollars. So blockchain is crypto is progressing very well, and of course business solution. So there's quite a lot products in the market. I just listed very few products. Not every fintech company is regulated. Not every fintech company is regulated. There are quite a lot fintech companies that act as a technology system or solution provider. They only provide their technology. They do not need to have a central bank or the respective financial services regulators license. So there is a huge business available, and those who are working in UAE, I'm sure you guys know Network International. Network International used to be a technology provider. Visa, MasterCard, still technology provider. They are not regulated entity, though in UAE somehow it is required by the regulator to get the designation of license, but it's not a requirement globally. So I'm going to take a pause here. If there is any question, any thoughts, any views, we have 5 minutes if you want to ask any question, and then before we proceed to the next module. Yes, guys, the floor is yours. Okay, no problem. So if there is no question, we will move to our module 2, that is key technology driving fintech innovation or fintech. The starting point is blockchain and distributed ledger technology. Now the question is, what is blockchain and because both technologies are same, it's not too different. In fact, it is not different. The terminology used because of certain reasons is there, but blockchain and distributed ledger technology both are same. What is this technology? I think that the description, if you see on the screen, is definitely a really good description. A technology that is based on blocks of record. It's just like, imagine if you are working for a banking institution or a maybe government organization where you have records available, years and years and years of record, and this record available in files. Little bit technology where institutions, they started keeping those records in the form of hard drives or other form of drives. This is again still old technology. But what block technology does? Block technology allows to create and share your record. I'll talk about the record shortly, but to create and share your record on a platform, digital platform or digital network that is not controlled by anyone. This is very interesting, that is not controlled by anyone. Although technology is definitely progressing, there are blockchain and distributed ledger technologies or networks that are controlled by institution. We'll discuss about this later on, but the concept still, and the main concept is it should not be controlled by anyone, and it's all digital. You really do not need to have a physical infrastructure to create to maintain this network. All the servers are available. Creation is happening through physical servers as well. This is called data mining. It is happening, or crypto creation. But it's just like internet. So internet is one form of your network. Blockchain is another form of network where you are creating your own record as a user, and you are sharing this record with others. Here is a very good description of blockchain technology. I know we won't be able to spend too much time to discuss two technical aspects of blockchain because we have short time. I won't be able to do that. But if you see here, you have a computer. You want to transfer funds from person A person A wants to transfer funds to person B, if that's the plan. Then through blockchain, again, if this person is part of blockchain network or platform, then it is possible. If you are not part of this blockchain platform, it is not possible. So how it works? A person A wants to transfer funds to person B. Both should be part of this platform. So when person A create the transfer using blockchain technology, they create a record. Now this record, if you see in the middle of this slide, you will see 4 boxes. So these 4 boxes are 4 nodes. Nodes means 4 person, 1 node means 1 person who is part of this blockchain technology. So 4 nodes means 4 person. So these 4 persons are, so once person A create a record, this record will be shared with everyone who is part of this platform, all nodes, and this data is encrypted. It means no one can tamper this data. So once this data is shared with everyone, it's just like a James Bond or maybe Mission Impossible movies, where if you retrieve a data secretly and you are afraid that if data is stolen or a criminal get the data back, then I will miss my data. So what this person, James Bond or in Mission Impossible, let's say Tom Cruise, they create multiple copies of this data. So if one is stolen, another is saved. This is the concept here. So if one record is created, then this record is distributed to everyone who is the part of this blockchain, and everyone, no one can tamper this data, but data is there. So that's why this technology is considered is more secure than the traditional technology where you store data. If a hacker access your data, they will eliminate everything, but blockchain it is not possible. So once
Is
everyone
it
receive,
is it accessible to everyone within that particular nodes, or you can say it cannot be tampered. So for example, tampered mean out is there if there is no one in if someone from outside tried to access this data, is difficult for him, or the within that particular group of people that can accessible, or it is only to those who can allowed it to use this data.
yeah, because Mosam, although we will take the question after this session, but I'm going to respond to the question. See, in blockchain, there are public keys and private keys. Keys means if someone has a private key, it is yours, it belongs to you. No one else can use this key and access unless you share a key with someone else. So that is why this data is very much secure. In conventional technology, there are different means to access the data. But blockchain, because it is based on public, and public means a key that can be accessed by anyone. Private key means one person holds this, so others cannot access. So answering to your question, no, it is impossible to access this data through typical methods unless you have the private key. So let's come to the process once again. So once this data is shared, and people who verify this data in all the nodes, then there are different products of this exercise. One product of this exercise of verifying, after verifying record, is creation of cryptocurrency. Creation of cryptocurrency, that is called mining. So mining is an exercise through which you can create cryptocurrency. It's not like you verify one record and you create. No. Earlier, yes, that was the process where you used to verify a record and you used to create cryptocurrency, but not anymore. Now it's millions and millions of transactions you receive, you verify, then one cryptocurrency is created. So it's a very extensive exercise now. It's not easy. And companies, they spend too much energy and time to create cryptocurrencies. Anyways, so that's the main concept of blockchain. Once it is created, then your transaction is posted. No one can access and no one can use a cryptocurrency platform. So blockchain, I think we already discussed that it's a decentralized digital ledger system that record transactions securely and transparently across a network of computers and nodes. I think this is very clear. I want to see you guys, it's a very interesting video. Definitely it will help you understand what is the use of blockchain technology, how to use it exactly. So I think it's a very interesting one. I would like to play this and we'll discuss after that.
What is blockchain? Blockchain is the decentralized ledger of all transactions across a peer-to-peer network. Wait, what? Okay, let's take a step back. How does an online transaction work mechanically? So you go on Amazon, you find a product you like, then you enter your credit card information and you checked out. On the back end of this simple online checked out process, there are quite a few parties involved in this transaction. First, you give your credit card's information to Amazon. Amazon would send authorization requests to the payment processing networks like MasterCard, Visa, or American Express. These payment processing networks would ask your bank for their approval to see if you have enough money or credit limit in your banks. Once your bank is done confirming that you have money, the transaction's validation goes all the way back to Amazon. Amazon would give you order receipt and your banks will send you your credit card statement. Every parties involved in this transaction would have their own version of the transaction record as well that will look different than yours. Before blockchain, these data and records would often store in data tables. Think of it like a boring, long Excel spreadsheet. Ledgers just mean these records in spreadsheet format. And centralized just mean that the companies control their own ledgers. So what we got before is data table is a centralized ledger of all transactions across a lot of middlemen. This is where blocks come in. A block is not a data table. A block is just a different ways to secure and store data. A block can contain any relevant data information about a transaction, like buyer, seller, the amount paid, the product order, or the date of the transaction. A hash is a unique identity of the block. You can compare this to your most unique, secure, encrypted biometric, which is almost impossible to fake. The last element of the block is the previous hash. Previous hash creates the chain to connect the block to the previous block hash that contains previous record. This makes blockchain very secure because it's extremely difficult to fake the identity of the block. Even when you manage to hack the hash, your blockchain will break because you would have to change all the hash before and after that block as well. Now to make blockchain even more secure, blockchain use a peer-to-peer network where everyone can have the same copy of the blockchain. These peers in the network act as an agent or node, monitoring the activities on the blockchain. If there's a new block trying to be added to the chain, everyone in the network will have to verify whether or not this block is valid. And that's Monkey Go for today. Subscribe to my channel and I will see you in the next video.
Yes, guys. So I hope this is the reinforcement of what we discussed earlier about blockchain and blockchain technology, how to use it. I would like to discuss some use cases of blockchain because uh, day before yesterday I was a speaker of one event and we were discussing about blockchain. But the overall impression myself and others have is there's so much discussion happening about blockchain, AI technology, and these are these modern technologies. But what are the use cases? Where exactly we can or we are using those? So I'm going to share a few use cases with you guys. First is of course money transfer. We discussed this earlier about money transfer. I don't think we need to spend this much once again. But money transfer, if you want to transfer money back home, there are few challenges. Although so many companies operating in the market, what's the value of blockchain? There are companies that seems efficient, low cost, etc. But what's the value? The value is unless you are involved in developing payments technology, you will not know the value because payment development of payment technology is very complicated. There are multiple parties involved, multiple risk involved, blah blah, and of course fraudsters sitting there as well. So payment technology is very complicated. Blockchain provides a solution. What solution? First solution is quick, fast, efficient. Now in banking, in payments world, although products are available that is instant transfer, but still most of the payments, they are not processed real time instant. There is a delayed payment process. It could be an hour, it could be a day, it could be a week, and sometime more than this. Number one challenge. Second challenge is cost. You transfer money, of course there are some cheap, low cost or zero cost solutions available, but still there is hidden cost, that is exchange cost. So the cost is there, and the risk, the biggest one is risk. So blockchain claims that blockchain is free of all these challenges. It's instant. A person Mr. X transfer to Mr. B immediately, real time, instant. Number one. There is no cost. Why there is no cost? Because there is no intermediary involved. I am sitting here, I want to transfer to another person, I can transfer directly. It's peer to peer payment. There is no cost involved. So this is second benefit. Third benefit is no fraudster involvement. Fraudster cannot access into your block or blockchain. This is what we discussed earlier. So the solution is very, very safe. Still, I do not want to call it foolproof, but yeah, it's extremely safe as compared to the traditional payment system. So that is one of the strong use case. So many companies, Ripple, Binance, and there are so many companies, they are using platform blockchain to transfer funds one country to another, domestic or international. There are other use cases. Cryptocurrency, I think we already discussed. Healthcare in blockchain. Blockchain technology is being used in healthcare to create your medical record, to save your medical record. I remember a few years back when I used to visit hospital or clinic, they used to file my record here and there and is it available or not, but not anymore. You really do not need to search old record, it is already always available. Supply chain really very important, supply chain really very important, because supply chain is very complex process, it's not easy. So in supply chain, all the information real time available all the time. So there are finance and banking, I think we discussed insurance as well. So blockchain, they have several use cases available as well. I've added few more use cases. Money transfer we discussed. Smart contracts. Now we are living in the country or the region where contracts has very strong value. Contracts are really, really valuable. You talk, you write something, everyone must be documented, written, clearly spelled out. So contracts are really important. UAE, Saudi, GCC, we are still operating through checks in writing documentation. So blockchain address this problem. I was training to Abu Dhabi courts a few years back, and the discussion we were having, legal matters is all about contracts. If you have a contract in place, you can do whatever you want to do. But the problem is it's so much labor intensive, so much documentation, physical record, there is so much cost. But smart contracts, you don't need anything. You just need a digital contract. Everyone can sign. It is stored. It's a very big, strong use case. Digital identity. So digital identity, what do you mean? What is the meaning of digital identity? I'm not talking about a digital copy of your national ID. You are from India, you are from Pakistan, you are from UAE, from Saudi. Every country, you are from US, green card. Every country have their own national ID. And this ID can be stored digitally somewhere. But I'm not talking about this ID. I'm talking about digital identification. That is your retina scan, let's suppose. Your DNA is your digital identity. So these identity can be created, easily created. It's just like a science fiction movie. When you go enter the door, you don't need to really swap a card. You just look into the device and doors are open, or you just speak, doors are open. So these are digital identification, and it is very easy to create through blockchain and of course voting system. So blockchain, of course, that's how blockchain is working. Another interesting area is artificial intelligence. Artificial intelligence, AI or machine learning. There is so much debate or discussion happening in UAE particularly because UAE established their Ministry of Artificial Intelligence, machine learning. Of course, they are doing it. But what is artificial intelligence? So artificial intelligence is intelligence that assumed to be beyond human intelligence, beyond human intelligence. That's an assumption. I'm not saying this assumption is right or wrong, but someone a human cannot do, or human do not want to do, and they want technology to take decision and process things very quickly. Video games is a good example. Video games is all artificial intelligence. It is based on artificial intelligence now. So this technology is being used to reduce pressures on human mind, to reduce labor workforce, humans, to reduce reliance on humans, and to take efficient and quick decision. Efficient and quick decision. This is all human intelligence and artificial intelligence. There are few use cases, but before we talk about use case, I would like to watch this video. It's a very interesting one about artificial intelligence, and then we'll continue from there.
When you hear the term artificial intelligence, what comes to mind? Superpowered robots? Hyperintelligent devices? Science fiction has familiarized the world with the concept, but outside of Hollywood, what is artificial intelligence and what can AI actually do? For starters, AI involves using computers to do things that usually require human intelligence. Humans can see with their eyes and process what they see. We can understand our environments and move around within them. Our brains have the ability to see patterns, and we have the ability to understand spoken language. Artificial intelligence is a broad branch of computer science that includes many different terms. In order for computers to achieve these capabilities, they require lots and lots of data. Large data sets allow AI algorithms to identify patterns, make predictions, and recommend actions. Artificial intelligence is already all around us, but today's best AI still can't compete with the human brain in some ways. For example, in 2016, the computer program AlphaGo defeated a legendary professional Go player. But if you asked that same computer to drive a car, or walk, or even play Monopoly, it wouldn't be able to do so on its own. AI's computing power is massive, but our human brains are able to tackle a much wider set of data and methods.
So that's the idea behind artificial intelligence. In this video, I'm sure you might have heard some very interesting terminologies, such as, of course, data is there. It's all based on data. Artificial intelligence is based on data. If data is there, number one. Number two, if data, using data, you very well trained your model, then you will achieve the results. It means if there is a problem with your quality of data, number one, or you are unable to train your model, you won't be able to get results. It means machines are not intelligent themselves. Machines are intelligent because we train them, we provide them those model and platforms to take decision. So it is actually computer language, it is actually computer program, not language, computer program that we train and they take quick decision. So there are few very interesting examples, use cases of using artificial intelligence. Let's say predicting customer churn rate for financial apps. Why customers are leaving our application so quickly? What is the attrition rate? We don't know. AI does this because AI, it study the behavior, it assess the behavior of customer, and then based on this give you analytics so that you can take decision. In some cases AI can take decision as well. Of course, that's the purpose. Otherwise, if human are keep taking decision all the time, then the use of AI is quite limited. Robo advisory we discussed earlier already, fraud detection and prevention. Now, those who work for regulatory financial services, or those who are working for as a compliance or regulatory expert, they know that behavior detection is a challenge. You don't know what customer will do in next 3-4 months. What's their customer can provide for their financial profile. I'm going to do this much transaction, I'm going to that would be my behavior, but it is not this is not an assurance from customer. You will not know. So in this situation, AI really working well. So especially mobile applications, those who are using payment platforms, mobile application, where payment fraud detection is very important. And I'll give you a few examples. If you are working for a fintech or you are a customer, you have a particular way of typing using your mobile application. You have a particular way of speaking using your application. You have a particular way to speak with your client service representative. What AI does? AI read your pattern, they study your pattern, and then subsequent to that they build a model where they decide are you the right person or not person, or you are fair, or your ID is compromised. So from fraud perspective, it's significantly helping reduce the fraud attempts. And financial forecasting, of course, because countries, developing countries particularly, they don't have financial planning, they don't know what to do. So AI is really providing them they create certain scenarios, and they perform scenario analysis, and they give you forecast of what's going to happen in the future. So I think this is one interesting video I wanted you guys to see to really understand the value of AI. Because see, development of AI model, everyone talks about development of AI model, but the question is this an effective model or not? Will this really help or not? Because in AI world or machine learning world, there are few challenges that is being discussed extensively. Number one, ethical AI. So ethical AI means uh, can you ask your robotic AI based girlfriend to say I love you? No, it is unethical. So they are the limitations. Can you expect a robot policeman to take action on itself because it is AI trained? This is an ethical issue. So there are certain, is it ethical to study the behavior of everyone all the time? There are certain situations you are depressed. So how exactly AI are going to treat this behavior, this mood? So there are so many ethical issues with AI. So it is really important to understand this 5-step process. If you want to create an AI model, what exactly you are going to do, what you need to consider particularly. So maybe let me play this video.
deep learning has enabled us to build detailed, specialized AI models. And we can do that provided we gather enough data, label it, and use that to train and deploy these models. Models like customer service chatbots or fraud detection in banking. Now, in the past, if you wanted to build a new model for your specialization, so say a model for predictive maintenance in manufacturing, well, you'd need to start again with data selection and curation, labeling, model development, training, and validation. But foundation models are changing that paradigm. So what is a foundation model? Well, a foundation model is a more focused, centralized effort to create a base model. And through fine-tuning, that base foundation model can be adapted to a specialized model. Need an AI model for programming language translation? Well, start with a foundation model and then fine-tune it with programming language data. Fine-tuning and adapting base foundation models rapidly speeds up AI model development. So how do we do that? Well, let's take a look at the 5 stages of the workflow to create an AI model. Stage 1, that is to prepare the data. Now, in this stage, we need to train our AI model with the data that we're going to use. And we're going to need a lot of data, potentially petabytes of data across dozens of domains. The data can combine both available open source data and proprietary data. Now, this stage performs a series of data processing tasks. And those include things like categorization, which describes what the data is. So which data is English, which is German, which is Ansible, which is Java, that sort of thing. Then the data is also applied with a filter. So filtering allows us to, for example, apply filters for hate speech and profanity and abuse and that sort of thing. Stuff that we want to filter out of the system so we don't train the model on it. Other filters may flag copyrighted material or private or sensitive information. Something else we're going to take out is duplicate data as well. So we're going to remove that from there. And then that leaves us with something called a base data pile. So that's really the output of stage 1. And this base data pile can be versioned and tagged. And that allows us to say, this here is what I'm training the AI model on. And here are the filters that I used. It's perfect for governance. Now, stage 2 is to train the model. And we're going to train the model on those base data piles. So we start this stage by picking the foundation model that we want to use. So we will select our model. Now, there are many different types of foundation models. There are generative foundation models, encoder-only models, lightweight models, high-parameter models. Are you looking to build an AI model to use as a chatbot or as a classifier? So pick the foundation model that matches your use case, then match the data pile with that model. Next, we take the data pile and we tokenize it. Now, foundation models work with tokens rather than words, and a data pile could result in potentially trillions of tokens. And now we can engage the process of training using all of those tokens. And this process can take a long time, depending on the size of the model. Large-scale foundation models can take months with many thousands of GPUs. But once it's done, the longest and highest computational costs are behind us. Stage 3 is validate. When training is finished, we need to benchmark the model, and this involves running the model and assessing its performance against a set of benchmarks that help define the quality of the model. And then from here, we can create a model card that says, this is the model I've trained, and these are the benchmark scores it has achieved. Now, up until this point, the main persona that has performed these tasks is the data scientist. Now, stage 4 is tune, and this is where we bring in the persona of the application developer. This persona does not need to be an AI expert. They engage with the model, generating, for example, prompts that elicit good performance from the model. They can provide additional local data to fine tune the model to improve its performance. And this stage is something that you can do in hours or days, much quicker than building a model from scratch. And now we're ready for stage 5, which is to deploy the model. Now this model could run as a service offering deployed to a public cloud, or we could alternatively embed the model into an application that runs much closer to the edge of the network. Either way, we can continue to iterate and improve the model over time. Now, here at IBM, we've announced a platform that enables all 5 of the stages of this workflow, and it's called Watson X. And it's composed of 3 elements. So we have.
So I think because now it's IBM's promotion is started, so I'm going to stop it here. Just a second, I think Mansoor Khatir is joining. So if you see here, the 5 steps process of creating AI model is, technology is not too important. Technology is very typical. A developer. So AI use traditional technology. The most important thing is the logic behind the logic built in this technology, the algorithms and the rules defined in this technology is more important. So yeah, this is about AI. Last topic of this module, module number 2, is big data. I'm sure we all heard about big data. It's being debated everywhere. So big data is nothing but utilizing. Sorry, just a second. I think someone is again there. I think Mansoor Khadir again. So big data is nothing. It's not something different. The only difference is utilizing data, utilizing too much data. Because in modern world, in modern financial services particularly, decision is based on data. You cannot take judgmental decisions. You cannot just assume things and take decisions. Decision must be based on data. So here the value of big data comes in, where you need to collect data, number 1, very important. Right data, not data with errors. Wrong data is not required. Wrong data is another issue, by the way, because from financial crimes world, if you see FATF, Financial Action Task Force, they have issued very clear guidelines on data integrity. So integral data is very much important in financial services, number 1. Second, this collection and then processing this data. And if you have huge data, extensive data, you need to. The time has passed where people used to fill in the forms, where different people have different views about a particular situation. But now it's not like this. There are data scientists available. They take decisions. They analyze the data and they take decision accordingly. So data is definitely very much important. Sorry, I thought it's the last topic, but the last topic of this module is open banking. It's very interesting topic, open banking, because again, this is one of the topic that is being discussed everywhere, whether you call it open banking, open finance. Open finance is the extension of open banking. Middle East is particularly, it is being discussed a lot, in Western Europe as well. What is open banking? And by the way, those who are residing in Middle East, UAE or Saudi, let's say, Central Bank of UAE, they issued open banking guidelines and regulations. Saudi Central Bank, they also issued. Bahrain Central Bank, they also issued open banking and finance regulation. Other than this, globally, Brazil, UK, US, Australia, these are the main countries. Those countries issued open banking, open finance regulation. But the question is, what is open banking or open finance? We can use this word in exchange of each other, open banking and open finance. So this is a very simplest diagram of open banking. The left hand side before open banking is a customer is connected with multiple financial institutions, whether it is bank or non-bank, independently. So bank A is connected directly with customer B. For example, customer A has a bank account with bank A. Customer has a bank account with bank B, a bank account with bank C. So these are independent relationship. So this is before open banking or open finance. But post implementation of open banking, Customer is not required to establish independent relationship with all the financial institution independently, because there is an intermediary involved. There is an intermediary that help you connect with all the financial institutions. This is called open banking. So open banking is the exchange of data. Open banking or open finance is the exchange of data among stakeholders through an intermediary, securely, without any cost. I'll repeat once again. What is open banking? So open banking is the exchange of data among stakeholders or market players, including customer, securely, without any cost. So the question is, what's the value of sharing data? Why do we need to share data? That's the main point. We'll discuss about it definitely, but if you see here on this slide, I'll enlarge this a little bit to see exactly. Open banking is a financial practice. It's not a product, it's practice that allows third party financial service providers to access consumer banking transaction and other financial data from bank and non-financial through API arrangement. So it means if you see now today Emirates NBD in UAE, let's suppose, ADCB, another bank, can ADCB reach out to Emirates NBD and ask for the data of customer? Impossible. They will never give you. One bank never cannot ask or cannot get the data of customer from another bank. It is impossible, or financial institution. But open banking, it is possible. In open banking, it is possible. For example, I want to establish a crowdfunding platform, a credit platform, a credit product, but I want to see the credit history of customers. I cannot reach out to banks and say, can you please give me data of your customer? No, they will not. Ittihad Bureau is there, but Ittihad Bureau have certain limitations. So with open banking, the benefit of is, if I want to establish this product, I can go and access the data. Now it looks very simple, but it's not that simple, because there is so much confidentiality, privacy issue are there, data privacy issue particularly, but it's very effective because customer data is not an asset or is not the ownership of a financial institution. It can, anyone can access, any financial institution can access to provide further services to customer. So this is all about open banking. Now open banking, I've used some use cases of open banking here. Let's take an example of payment initiation service. What does it mean? What is this service? So payment initiation service means if I am a customer and I want to collect funds from one place where my funds are stored and I want to give funds to another person, I don't want to be in a situation where I need to initiate a very long order placement process through my online banking, and then there is a whole process of banking, then they transfer fund to another party involved and they receive, they provide me confirmation. I don't want this headache. What I need, simple process where without asking my bank I can initiate a transaction here. So there are services provider that initiate customer transaction on behalf of customer, that is called payment initiation. This is example. So in open banking, three main services are being offered typically globally. Number one is payment initiation service, where a third party after your instruction can go collect your funds from your respective institution or pay to someone else. This is one product. Second product is account information service provider or account information service. So like for example, if you see in this slide, the right side, where a customer is connected with all the banks through API. What is this model? If you think from account information services perspective, you as a customer, you want to see, I don't want to access my 3 banks and see what is my balance there. I want to see everything in one application. what is my balance in bank A, bank B, bank C without entering into bank. This is account information service, and this is open banking solution technology providers, they provide the service. And third is of course data exchange. So these are the main, of course I won't be able to spend, but I've given several examples. For example, you see Wise. So Wise is Wise is a cross-border funds transfer company. They are using open banking platform to transfer funds from or initiate payments. QuickBooks, those who are using technology, they are using the same open banking platform, and utility subscription management companies like Emma, they are also doing it. So there are quite a long list of platforms they are using open banking platform very successfully. I'm going to take a pause here. Any thoughts, any question you would like to ask? We have 5 minutes before I move to the next module. No questions? No problem. We will move to the next module, that is module 3, and that is fintech business models. So we will be discussing different fintech business models. First one, I am going to take examples of P2P lending. Now why this is important, P2P lending? P2P lending means peer-to-peer lending or person-to-person lending. So imagine a person who needs funding for whatever the purpose is. It could be for personal use, this person needs some funds, or to support business, or to support family or kids education, whatever the reason is. In the past and still, not just past, still the process would be you need to reach out to either a bank or a lending institution such as microfinance bank or similar kind of institutions. You need to submit an application with the financial institution. This financial institution takes and used to take days and weeks, sometimes months, to process your application, and before they sanction you loan. Now you may miss the opportunity to use this amount and the cost is extensive, because microfinance, the typical microfinance lending cost globally is 29 to 40% of the total principal amount. So it's very expensive microfinance, small loans particularly. So what's the value of these services then? So because of these challenges, the concept of P2P lending introduced, including crowdfunding. P2P lending including crowdfunding means what? You know, you are two persons, you are not relative, you don't know each other, you are not friends, but I am the one who is happy to lend funds or money to another person whom I don't know who this person is. I don't know much, in fact I don't know, we never met. So there is no relation, but I am still ready to lend based on certain agreements. Now this does not require involvement of banking, it does not require extensive risk management, credit risk management, it does not require huge cost. What it requires, my willingness to pay to someone, to lend to someone, this is my willingness, and the platform availability, that is it. It is quite simple. So pay-to-pay lending platform transformed completely the landscape of credit institutions such as crowdfunding. Now what is crowdfunding? Crowdfunding is, if there is a project there is a purpose there for loan, then several institutions and individuals, they come together to support this cause. Cause not necessarily a moral cause or a national cause or economic cause, it could be any cause. And they fund this cause through a digital application without significant involvement of intermediaries and time spent and cost. So, it is a very interesting model. Like for example, if you see this slide, there is a borrower, there is a lender, and in the middle there is an application. Both sign a partnership contract and that is it, a very simple model. So, this is the out of the box thinking of fintech. This is the out of the box thinking of fintech, where you do not need so much bureaucracy, you do not need so much credit risk assessment and incurring the cost. So, it is one interesting, I personally call it the benchmark. When you want to think about fintech, this is one of the benchmark to think about fintech, how fintech thinks differently. The primary difference, I believe we already discussed, I do not want to spend too much time on this. We discussed intermediaries involved, there is no involvement or much involvement, application process, cost is definitely high. If you are going to get a loan from a bank or a regulated financial institution, the regulations are quite stringent, and of course, accessibility is not easy. So, these are the few important aspects of P2P lending. New bank or challenger bank, new bank and challenger banks. It's I don't want to say it's a very new concept, new bank and challenger banks, but it's worth exploring what these guys are doing. What is new bank? So, before we discuss about new bank, let us talk about typical banking system. In typical banking system, banks have physical branches. Now, banks have introduced their online banking as well. So, physical branches, and then on top of physical branches you have online banking. This is called digital banking. So, the starting point to understand challenger bank and new bank is existing banking. So, existing banking is your physical banking with physical branches, and on top of this your online banking, whether it is mobile banking, whether it is your web banking, internet banking, this is called digital banking. So, it is there, it is happening. But what happened, banks started realizing, maybe there is someone, let me admit this person, it is Imran Khan, okay. So, what Imran, can you please go on mute? Thank you. So, what banks realize that physical location is very expensive and it is not serving the purpose, because if your services are being digitized, if everything is becoming digital, then what is the value of having physical locations? So, subsequent to this, banks start thinking about digital banking, beyond digital banking. So, they introduced challenger banks. What is challenger banks? So, challenger banks are again banks, conventional banks with very limited physical presence, very few branches. The concept started years back from UK, from Britain, challenger banks, and so they are regulated banks, but they have very few physical branches, number one. So, one differentiator between conventional digital bank and challenger bank is very few branches, number one. Number two, these banks do not offer full suite of services. Digital bank, when you, if I ask you to establish a bank, forget about digital bank, if I ask you to establish a bank, you will start thinking, oh, I need to establish bank accounts, and then saving account, then checkbook, then ATMs, then online banking, then credit, then business payments, blah 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 blah. There is a long list. It means it is very difficult to establish a bank. Challenger bank brought an idea, and the idea is, why do we need to offer all the products and services? We can pick and choose our own services. We may offer all services, we may not offer all services. So, the services products are relatively few, as compared to a full-fledged bank, but again it requires your a banking license. And the most advanced one is called neobank. Neobank in fintech world, any digital company call themselves neobank, although I do not agree fully on this, but neobank are fully fledged digital bank with no physical presence. Revolut is an example. Revolut is an example, Monzo is an example, N21 is an example, and there are so many other examples. They are fully fledged digital bank, number one. Number two is, though they have a regular license for sure, but number two is they pick and choose their service. They do not enter into everything. Maybe they do not offer accounts, they just offer wallets, but still they are banks. So the choice is quite limited. That is why these banks launched very quickly, and they progress very quickly, and they offer their services very quickly. This is new bank. So I want to watch this video about if you want to launch a new bank, what would be your approach to launch a new bank.
The banking and financial services sector is undergoing a radical shift and giving way to a new age of banking services. Neobanks are millennials' new way of banking. The experience and satisfaction offered by most traditional banks are not up to the mark of modern customers' expectations, and neobanks are here to fill that gap. Neobanks are financial service providers that do not have a physical branch and operate entirely online. They offer a wide array of services that appeal to modern customers. Some of the key benefits are 24/7 service availability with personalized customer experience, cost-effective to both service providers and customers, offers advanced financial services and products, additional revenue for banking and financial institutions, significant reduction in service fees. Thinking how you can launch a neobank app? Here are a few things you need to consider before launching a neobanking platform. First, discover your USP. Define what financial service problem you're trying to solve, or what new experience or benefit you can offer your customers. Obtaining a virtual banking license is another important step. Partnering with a traditional bank and claiming a license to offer your financial services is the easier option. Next, focus on experience design. The whole point is to provide financial services with a modern customer experience. So make sure to design your app's UI, UX according to modern customer experience principles. To ensure your app's success, thoroughly evaluate the product logic and practicability. Develop the app with state-of-the-art tools and technology stack, and do extensive and rigorous security and performance testing. And don't forget to collect user feedback about your neobank so that you can improve on the features and functionalities. AccuBits offers a wide range of services and solutions to help you launch your neobank app in the shortest time. We offer custom neobank app development and white label neobank platforms and solutions. Are you planning to launch a neobank?
My apologies, everyone. I think there was a technical issue in my team, so I just rejoined. Guys, can you hear me?
Yes, I can.
Okay, excellent. Okay, let me share my
Yeah, we can
screen.
hear you.
Okay. So I don't know where did I stop, but maybe I'll. Okay. Where it stopped. So we were discussing about neobank. That few important points I highlighted from this video is number one is your USP. USP means unique selling point. Now, why it's really important? Because if you want to differentiate, your new bank from maybe just a second. Can you see my? I think my camera is disabled probably. Let me share my camera too.
Rashid, one more thing, we are unable to uh, put anything on chat.
Oh, okay, okay. So let me enable chat as well. Just a second. I need to change a little bit configuration. Give me a second. Let me change the setting.
Sure.
I'll figure this thing out, but it's fine. Let me first complete this small part, then we'll move on. Activating the chat box. I don't know. It should be you should be able to do that, but
Check is showing allow camera for attendees.
the camera is there.
No, that is for the attendees.
Yeah, not for myself.
Okay.
It's okay. Let me.
Just show the presentation.
Yeah. Yeah. So here's the presentation. Can you see my presentation now?
Yeah, I can see.
Yes, we can.
So Imran, can you please go on mute? Okay, thanks. So let's talk. So USP is why USP is important. The reason is, see, if you talk about conventional banks, they know what their product suite is. So they do not really need to think from the beginning that what exactly they need to offer. How different you are as a new bank, how different you are. And I'll give you one example of, let's take an example of Revolut. Revolut is going to launch in UAE as well. How they are different? So in their platform, they have a mobile application. In their mobile application, they offer you typical products such as they have their wallet, they have their cross-border transfers, blah, blah, blah. It's there, fine. But they have several open banking services. They have several third-party services available. They have crypto including as well. It means their suite is modern, and the UI UX is quite modern as well. So people like it. People really want to see a modern UI, and the cost is quite low. It's quite cheap. It's too low. So that is one unique value proposition. Unique value proposition of neobank. Number one. Number two important thing is, do you need a license as a new bank? I'm sure you might have heard in the video is you may not. It's your choice at the end of the day. Because banking, you need to go to the central bank and ask, oh, I want to launch a bank, I need a license. But neobank, you can ride on a license of an existing bank. It's very cheap, economical solution. You do not need your own license. Just develop your technology and offer your service. You don't need to although there are some commercial challenges. Commercial challenges means probably for you it's little expensive, you want to give a cheap product to customer, there is a possibility. Then there will be certain controls with the license issuer bank, they will want to control certain things, but it's a quick win, you can launch very quickly. So I think this is one interesting proposition. People can, and again, when you launch a new bank, does not mean you really need a very huge, big building, big team. No, you can launch a new bank with 10-15 people, team members. That's it. You really do not a very big team. So this is about new bank. Last topic from this module is buy now, pay later, BNPL. So BNPL is in the market, it's been a while now, buy now, pay later, but it's not new. BNPL is not new. BNPL in the financial services from years and years, since cards started banks started issuing cards, whether it is your debit card, your credit card, whether it is your prepaid card. So what is buy now, pay later? Earlier it used to be delayed payment. We used to call it delayed payment. For example, you have a credit card, you are unable to pay on time, it is called delayed payment, intentionally, unintentionally, whatever the reason is. But now BNPL is a formalized product, it is a licensed product, not necessarily offered by banks, but non-banking institution as well. What does it mean? So BNPL means if you have a card, if you have a credit card, it's typically applicable on credit card. Debit card is not really applicable on debit card. The reason is debit card funds are already available with the bank, with your financial institution. So it's mainly applicable on prepaid card as well, but mainly on credit card. You have a card, you purchase something. Now if you want to pay now or you don't have funds available to pay now, both options are available. For example, you want to go Amazon, you want to purchase something, you purchase, but then you will have offer from Tabi, from Spotty, from other companies. They take the risk, and they give you offer, okay, don't pay now, you can pay after 2 months or 3 months or 4 months, whatever the agreement is. This is called BNPL. So 21 or 22, 2021, 21 and 22 particularly, not 21, 22, and to some extent 23 as well, was the worst year for BNPL. So many losses in this industry. I am sure if you go, you see the report of Australian regulators, BNPL, huge loss. And the main reason of this huge loss is by 2022-23, BNPL was not a regulated activity. It was not regulated by regulators. But 2023, when industry suffered huge losses because of credit risk, regulators decided to ask BNPL companies operating in the space to apply for the license globally, most of the countries. Now BNPL is a regulated institution in several countries, including UAE. Central Bank of UAE, they issued BNP regulations. It is part of your financial companies regulation. So this is about BNPL. I am going to take a pause here. Any question, any thoughts, any view you would like to discuss? We have a 5-minute break and we can definitely take your questions. No questions? No problem. Okay. Let's move to our next module, second last module, about the regulatory landscape. In fintech space, regulatory understanding of what the role of regulators and regulatory requirements is very important. As I mentioned in the beginning, when fintech started earlier, fintech was not regulated before 2000, year 2000, let's say. It was technology company. But then fintech companies decided to enter into the space to offer regulated services. And regulated service, there are multiple reasons. One of the reason of to become regulated is of course to offer your services directly to the customer, but there is another angle of a regulator, that is to safeguard customers' interest and safeguard economic impact of the country. That is the main reason. So then both sides, the story of both sides is both decided to issue several regulations and start regulating fintech companies. I'll play this small video. It's very interesting one to see. I think Naveed is there. Okay. I'll share this small video, interesting one to see how fintech experts see the regulatory challenges and perspective. So let me play this video.
Work with a true broker.
If you are unable to hear the sound, just let me know. I'll try to fix it, but hopefully you will hear everything.
Today, Bayou.com. Real data, real brokers, real properties.
Hey, give me some of those gluten-free cupcakes that I love, and tell my stockbroker to send.
How does a fintech startup deal with regulation concerns? Okay, this question also said a lot of ideas seem to end up in a dead end as soon as one realizes the amount of regulatory concerns to deal with. All right, the first thing to recognize here is that not all areas of fintech are heavily regulated. Most people think of payments, lending, and traditional banking when they hear fintech, and yes, these areas are pretty regulated and you better follow the rules. If you're going to actually trade securities with your fintech app, then yes, there's also some regulations to be careful of. Starting a stock exchange, now we're getting into the thick of it. There's actually a whole industry out there called Reg Tech, but it's mostly geared towards helping large existing institutions streamline regulatory processes. And their technology is often so expensive that it's inaccessible to fintech startups. But there's also companies like Intrinio who just source data sets from public places and outside of following stock exchange rules, don't really run into any regulatory concerns. There's plenty of room to innovate in lightly regulated areas of fintech. So if this is a concern of yours, then just start there. But if you're itching to start something in a highly regulated space, remember that great things are often very, very difficult. In the heavily regulated fintech space, your time, CapEx, patience, and willpower can actually become your competitive moat. Founders and CEOs who are willing to put in the hard work to get through the regulatory barriers are the ones that oftentimes win. Keep in mind that regulations do change, although not very quickly, so you've got to be agile and ready for that too. And lastly, if you're going to go this route, you better have a hell of a lot of conviction for what you are building. It took the stock exchange IEX over a year to get regulatory approval to become an exchange. An early startup plan, that's a lifetime, and it costs money to wait that long. So diving into the land of regulations wouldn't be my first choice. But if you really believe in what you're building and you've got the patience to get through the hard part, you'll probably have built something pretty formidable on the other end. So stick with it.
This is very interesting. I think now it's enabled. Let me enable my camera. Yeah, this is good now. So let's go to the fintech part once again. Now, in the video and myself, we discuss about the heavily regulated fintech companies. If you see this table, heavy regulated means either it is regulated by a central bank, any regulator, there is so much scrutiny, there is so much supervision from the regulators, etc. Whether it is your KYC, whether it is your record management, whether it is your reporting obligation, and there is so much lot. So usually what happen, banks, what type of the bank, whether it is new bank, your challenger bank, your digital bank, your conventional bank, they are heavily regulated. It requires reporting to the regulator, to inspection from the regulator, audits, the risk assessment. There's a lot of requirement, and the risk as well, because if you are not compliant with the regulatory requirement, then there is a risk. Payment gateway is another example. It's heavily regulated. You are doing transaction from payment gateway, swiping your card, whether you do this on a grocery store, whether you do online through Amazon, anyways it is payment gateways and lending platform. So, these are very highly regulated entities. Moderately regulated means where regulations are required, you have to be regulated, but there is some little relaxation. That includes insurance tech. Why insurance tech is relatively moderately regulated? Because insurance tech is not an insurance company directly. It is an insurance technology provider where they use a different insurance company to offer products. So, because they are not issuing policies to the customer directly, it means there is some relaxation on the regulatory. The same way wealth tech, where you are not storing client fund in your institution, but what you are doing is you are just a technology platform, or you are facilitating or promoting services of another provider or third party wealth solution provider. So, that is why it is relatively moderately regulated, because obligation is split, the responsibility is split among different players, the same way as RegTech. There are some companies that do not require become regulated, such as your financial education platform, companies that provide financial awareness. And recently in UAE, one company launched Yabi with the name of Yabi. Yabi is a financial education platform. You do not need to be regulated unless you really want to. And personal financial apps where expense, your budgeting and tracking. These companies do not, although it is fintech companies, but does not require being regulated. Another important aspect of regulation or being compliant is regulatory sandbox. Now, this is very interesting area of regulatory sandbox, because when fintech started, let us say early 2000, when fintech started, fintechs have an idea what to do, but they were not 100% sure what exactly their model is. On the other hand, regulators, they have a very typical regulations issued. They had regulation of banking, they had regulation of exchange companies, they had regulation of finance companies, that is it. Now, if a company like fintech, they want to offer their service that is quite unique, regulators did not know what to do, they were confused. So, from there this idea of a regulatory sandbox emerged. Not just government regulatory sandbox, but private sandboxes also emerged. And governments, regulators, especially developed regulators, whether it is FCA, whether USA FinCEN or other regulators, they established sandbox platform, sandboxes within their regulatory jurisdiction, where these companies, fintech companies, they can enroll themselves, they can develop their product in the supervision of the central bank, and central bank test this product before it is offered or launched for the public. So, a new product where regulations are not there, and I will give you an example. I was working with Saudi Central Bank SAMA, and there was a challenge with SAMA, and the challenge was in Saudi. I'm talking about, I believe, late 2020 or early 2021. The challenge SAMA had is there were so many companies and players fintech, they want to offer BNPL, buy now pay later, but the problem SAMA had, they did not have BNPL regulation, and what to do, there is a problem. So, how they address this gap is, they said, okay, we do not have BNPL regulation, but companies really want to launch BNPL in Saudi Arabia, then use microfinance financial institution framework for the time being to launch your BNPL product by the time we issue new regulations. So, these are the gaps everywhere globally, not just Saudi. Saudi is just an example, it is globally. Private incubators and accelerators, they also use this opportunity. Incubators are private institutions that ask these technology companies to come and test and develop product in their premises and then launch it. The same way accelerators. Accelerator is another form of incubator. The only difference is accelerator support usually those companies that are somehow established, but they want to launch their service quickly after getting funding. So these are, there are so many private incubators, accelerator. In fact, MasterCard and Visa, these big card schemes, they are offering their own incubators and accelerator to promote fintech. These are few examples of few accelerators and incubators it is operating, such as FCA of UK, Monetary Authority of Singapore, MAS, ADGM in UAE and DFSA in UAE as well. They have their own regulatory sandboxes on for compliance, for digital assets, etc. Incubators, again, level 39 of UK is a very popular incubator. Fintech Innovation Lab of UK, again, is a very it support early stage fintech companies to develop their ideas. And then accelerator, Y Combinator and Play Fintech, Plug and Play, sorry. Plug and Play is a very strong accelerator of US, and they support from investment perspective a lot. They invest a lot in fintech companies. So these are the incubators and accelerator and sandboxes that really help you progress very quickly. I'm going to take a pause here. Any thoughts, any question on the regulatory part before I move to the 5th module? Yes, guys. Nothing? Okay. Then let's move to module number 5. Just one small question to the team. Can you guys, are you guys able to write comments in text box? Can you do that? I see text box is enabled now, chat box.
No, we are facing the same issue.
Same issue because it's enabled, but okay. I'll figure this thing out.
In the Q&A, I think so we can put the comments.
Q&A?
If you want to put some question and want to update some comments for the chat or something, and put in the. As I mentioned, like just now, I mentioned hi. You can see in the Q&A.
I'm checking it now. I see, Imran. Yes.
Yeah. So
Yes,
instead
we
of chat,
can.
I think
Yes.
so. So we can use the Q&A.
So we can put our email addresses over there.
Yeah, I think so. What do you say, Rashid? Are you okay with that?
Yeah, I'm okay.
Okay, thanks.
Perfect.
Hi, I just tried. This is not available QA for the meeting participants. If you can recheck, Imran.
So
This meeting does not allow.
I just checked one of the participants also confirmed that he can use.
Okay.
I'm just
right.
putting. I'm just trying to put my email address. So maybe.
So I think those who are unverified in this meeting cannot use the QA. Maybe that's the reason.
Maybe you're right.
Okay. Bye.
Okay, thank you. Let's move to someone is on unmute. Okay. Module 5 is about fintech innovation in payments. Payments, as I mentioned in the beginning, payments is 70-80% of fintech is all payments, different forms of payments, 70-80%. So that's why I picked this topic to discuss about innovation in payments. See, payments is very standard process. So payment is transfer of funds from one person, that is payer, to another person, that is payee, for a purpose. That's payment, that's it. Now whether you call it cross-border funds transfer, it is again payment, because one person transfer funds to another person for some purpose. Whether it is swapping your card on a POS, it is again payment, because a customer is transferring funds to the merchant for some purpose, or whatever. There are so many examples of payment, but ultimately it is payment, transferring funds from one person to another. This is a simple example. To using this example, regulators were really struggling to introduce different form of product for different reason. One of the product central banks globally, they were and they are interested is to launch CBDC, that is central bank digital currency. The question is, what is CBDC and why central banks they want to launch CBDC? There are several reasons, but one of the reason is cryptocurrency. One of the reasons is cryptocurrency or virtual assets, because virtual assets, that is, or cryptocurrency, that is a private currency not issued by central banks. It is taking over your conventional currencies or fiat. People, instead of using fiat, they are using cryptocurrency to do their trade or funds transfer. So this challenging the position of central bank, because central banks they are the custodian of your currency, they are the custodian of your trade. So they are challenging the position of central bank. So central bank realize that there is a serious need to introduce central bank digital currencies. Now, what is CBDC? CBDC is a digital currency of a country. It's a digital currency. For example, in UAE you have dirhams, in Saudi you have Riyal, Qatar you have Riyal, Bahrain you have another currency, US you have dollar. Instead of using your physical cash, you have a digital form of this cash available with you. It's called CBDC. Now CBDC have two forms. One is a retail CBDC and second is wholesale CBDC. Retail CBDC is that myself, yourself, we can use it. We can use it. So instead of having, like for example, tomorrow you are working for a bank and bank instead of, so right now what banks are doing, when they want to pay you salary, they transfer funds into your bank account and then you have cash available in your bank account in the form of cash. When you want to withdraw this cash, you have to withdraw this cash from ATMs or exchange houses or bank branches, whatever it is. So it's physical currency. But imagine tomorrow your employer bank, they do not want to give you physical cash. They transfer you digital cash completely. A digital cash that you really do not need to withdraw from ATM. You have digital cash available in your wallet and you go to an grocery store, use your mobile wallet and transfer it to them. That's it. You do not need to, although one way or another somehow it is happening, but that's the concept of CBDC and you can keep it anywhere. Now this concept of CBDC is definitely very, and of course you can do cross-border transfer as well. But the concept of CBDC somehow is challenging the position of banks. If central bank issues CBDC, why do we need Emirates NBD? Why do we need HSBC Bank? Because then we do not need bank accounts. So an interesting video I would like to play for you guys. Have a look at this and we'll then discuss about CBDC further.
UAE will host free courses on learning how to invest in the stock market. In the course, you will learn how and when to invest.
In one of our previous videos, we discussed that central banks were experimenting with their own form of digital currencies to counter this tsunami of cryptocurrencies we are currently witnessing. You see, central banks dislike private decentralized money like Bitcoin because they can't control the supply of it. And it also threatens the sovereignty of their own national currencies. Hence, numerous central banks around the world, from countries like China to Sweden, South Africa to the European Union's ECB, that's European Central Bank, are working on their own state-issued CBDC. So what exactly are these CBDCs or central bank digital currencies? How will they affect you? Let's dive straight in. A CBDC is a digitized version of a domestic currency that's equal to physical cash that you and I use, or the reserves that your commercial bank holds at the central bank. I'm sure you're thinking, wait a minute, my money is already digital. From my payment apps to my bank transfers to my credit cards. We're not, after all, physically transferring cash when we pay each other, right? Well, these transfers where we pay each other online are account-based debits and credits that are essentially happening between commercial banks. I pay you, my account is debited, your account is credited, and that settlement takes place between our respective banks. These accounts are not stored at the central bank level. Central bank digital currencies, however, are a direct liability of the central bank and are most likely token-based, where these tokens would be represented on a blockchain established by the central bank. Unlike public blockchains like Bitcoin and Ethereum, where the information recorded is available to all, these are private or permissioned blockchains, which only the central bank and the parties it chooses can have access to. Now, there are two kinds of CBDCs. Wholesale CBDCs that facilitate payments between commercial banks and central banks, or entities that hold their accounts with central banks. Now, these have more to do with the infrastructure and the plumbing of the financial system and don't affect you and me directly. The other one is retail CBDCs that can be used by businesses as well as people like you and me. Imagine holding currency in your mobile wallet and the currency is directly issued by the central bank. Now, this could have huge implications for any country. There are so many unbanked or underbanked people in countries like ours and other developing nations around the world. Retail CBDCs could make a strong case for financial inclusion because the central bank could directly transfer funds to the unbanked, as long as they have a mobile phone. Imagine funds being transferred for COVID relief and to help people during natural disasters. The central bank could also utilize CBDCs as a tool to influence monetary policy. To spur spending in order to kickstart the economy during recessionary periods, the central bank could theoretically add an expiration date to the money transferred. So you could be compelled to make purchases with that money instead of hoarding it. This would increase the velocity of money in the economy. The opportunities are plenty, but there are a few risks involved as well. If we could all hold our money with the central bank, why hold money at your neighborhood branch of a commercial bank? This could lead to a run on your commercial bank and could have grave consequences for the entire banking industry. Now, it's highly unlikely the central banks would want to risk that because A, a strong banking system is crucial for the financial health of an economy. And B, central banks just aren't designed to deal with millions of retail customers. So the approach is most likely to be two-tiered. Issue the CBDC to the banks who then issue it to the retail customers. This would allow the authorities the room to experiment with this new financial tool without disrupting the entire banking model. Technology is changing money as we know it, so let's embrace it with open arms. Thank you for watching, and I'll see you next week.
Yeah, so this is about CBDC. I'm sure we discussed this in detail already. Central Bank of UAE, I think this is one interesting slide I prepared. Central Bank of UAE, they issued their CBDC. They are testing this CBDC particularly with India, and it is wholesaled CBDC. But other countries such as Bahamas, they already have retail CBDC that individual customers like me, like you can use CBDC instead of your fiat money, physical currency. Nigeria, they have e-Naira. So e-Naira is their digital currency they can use. But there is one interesting document I want to show you is cbdctracker.org. It's a tracker. You can access this website and you can see which are the countries that are already working on CBDC. For example, if you see here Russia, if you see here China, if you see here Saudi Arabia, Yemen, they are already working on CBDC, piloting. Which country launched? Which country launched? This is proof of concept with Canada. So proof of concept means it's not started yet and they are just discussing it internally. which countries launched CBDC successfully? That is, sorry, what is this country? I think Zimbabwe already launched CBDC successfully. Where is UAE? Yes, UAE. It says proof of concept, but it is already launched with for wholesale customers, like cross-border transfer, not the retail one. So it's a very good site. If you get a chance, if you really want to track CBDC progress, you can probably refer to this website. Another topic on module 5 is virtual currency, cryptocurrency. We all know cryptocurrency. I think it's not something new. It's getting so much traction now, so much volatile. Bitcoin, I remember that when I first started trading Bitcoin back in 2018, I believe, and the first time I traded Bitcoin, it was 8,000 US dollars. Now it is about to reach 100,000 US dollars. It's not there yet, but it is about to reach. So of course cryptocurrency is it's progressing very good, and it's going to compete with your fiat for sure. So what regulators are trying to do is they are trying to create an environment where cryptocurrency must be backed by an asset. Backed by an asset, could be a fiat, could be gold, could be any other form of any other asset, because then there is a guarantee. Otherwise, if it is not backed by anything, it's like gold standard economy years and years back, where central banks used to store gold, and they used to give guarantee against gold. Now it's not happening. So let's watch this video about crypto assets, and then we'll continue from there.
You may ask yourself, where do bitcoins come from? Bitcoins aren't printed out like traditional money, they're mined out of the system. A miner is just a person with a computer that runs a mining program on it. The reason it's called mining is because, just like any other natural resource, there is a finite amount of bitcoins. The maximum amount of bitcoins that can be generated is 21 million. Until today, over 12 million bitcoins were mined. Just like real-world mining, you need to invest energy in order to extract these bitcoins. These miners' computers need to solve complex mathematical problems, and once it solves them, new bitcoins are generated and awarded to them. But miners don't just generate new bitcoins. They also use their computers to verify transactions and prevent fraud. So more miners means faster transaction verifications and less fraud. That's why we want to compensate miners for their hard work. When verifying a transaction, the miner gets a small fee out of that transaction for his work. So miners get paid twice. Once for verifying the transactions, and again when they successfully generate new bitcoins. Sounds profitable? Well, not so fast. Satoshi, the guy who invented Bitcoin, wanted the number of bitcoins that were mined each time to remain constant, no matter how many miners came aboard. That's why the difficulty of mining increases as more miners join the network. In 2009, you could mine 200 bitcoins with your personal computer at home. In 2014, it will take you about 98 years to mine just one. That's why ASIC miners were invented. Super powerful computers designed just for mining bitcoins. But since so many miners have joined in the past few years, it's still almost impossible to mine alone. To solve this problem, mining pools were invented. Groups of miners formed together to deal with the growing difficulty of Bitcoin mining. Each miner gets paid for his relative share of the work. So, that's how Bitcoins are born, through miners. For more information, visit 99bitcoins.com.
So this is one aspect of virtual assets and cryptocurrency. I think the flow is quite obvious, but few things when you talk about virtual assets or cryptocurrency, you really need to understand not from customer perspective particularly, because for customer at the end of the day it is an asset, and they purchase this asset right now through fiat, tomorrow maybe something another way. But from a VA issuer perspective, if you want to issue virtual asset or you want to become a part of this industry, you really need to understand a few important aspects and activities of virtual asset. Now here I've created one table. This table talks about different activities virtual asset companies can provide. Like for example, if you want to become as a fintech, you want to become a virtual asset service provider, what can you do? The first thing come in our mind is, if we want to issue a virtual asset, so are we going to create our own virtual asset cryptocurrency? Is this the plan or something else? So to answer this question, it is important to understand different activities, typically global regulators in globally, not just UAE or other countries. Globally, these are the different activities virtual asset service provider can do. First is advisory services. So advisory means you do not create virtual asset, you do not store virtual asset, you do not trade virtual asset. What you do maximum is you just advise on, just like wealth financial expert, that buy this virtual asset, trade this virtual asset, and that's it. This is the lightest service you can offer. The second service is broker service and dealer activity. So broker dealer means you purchase virtual asset from one person and you sell to another person. It's kind of a trade, broker dealer. You can do it directly, or sometimes you do not do directly, but you connect the parties. For example, one is customer and one is virtual asset service provider. You connect both and that's it. Just like insurance companies, sometimes insurance companies, what they do, they connect buyer and seller. So the same way broker dealer does. Issuance. Issuance is the most difficult one. Why? Like for example, I'll show you a table. Maybe I will move a little bit earlier. Different cryptocurrencies globally. Bitcoin. So right now the market capitalization of Bitcoin is $458 billion, means this value of Bitcoin is circulating in the market. Second is Ethereum, $216 billion. Tether, USD coin, Binance coin, Ripple, or there is a list of 10 different cryptos. Does this mean that's it? No, there are several cryptocurrencies circulating in the market. They are in the market where their market capitalization is $100 maybe maximum. They are really very new. So it means companies are still interested to issue cryptocurrency, number one option, or issue a coin. Coin is a derivative of crypto. It's not a crypto directly. It is backed by crypto. One crypto or multiple crypto, depends on. But issuance of crypto is the most critical one or difficult one, because central banks usually have very extensive requirement to issue crypto. Then custody services. Custody services means store crypto somewhere. For example, I want to become a cryptocurrency trader, but I do not want to store those funds with me. Let's take a simple example. Banks, what they do is they are offering gold storage. Bank offers gold storage to customers. In UAE it is happening. Where does this banks store gold? In their own safe? Bank branches? No. They have third party custody service provider. They store these gold there. The same way virtual asset service providers, they not necessarily store funds in their own premises custody. They store these crypto assets somewhere else. So this is a custody provider. Crypto exchange services. Exchange is the most prominent one, where different crypto assets of different companies, whether it is Bitcoin, whether it is Ethereum or blah blah blah, it is traded there, just like a stock exchange. So then they are lending and borrowing services, virtual asset management services and transfer services, and these are primary. So you need to pick and choose what exactly you want to offer. You want to offer everything, you have to take multiple licenses. But if you want to offer some specific particular services, you can rely on it. These are cryptocurrencies already that is being offered in the market, and yeah, there are you can access let's suppose Binance website, and you will see so many cryptos are being traded there. So, I am going to take a pause here before I move to the last slide, and if you have any question, last module, sorry, if you have any question, we can take for 5 minutes questions, otherwise I will move to the last topic.
Yes, Rashid bhai, you said digital currencies like it is already in testing phase between India and UAE. So what will be the value of that digital currency? Is it the same like the fiat currency?
Sorry, can you come again?
I'm saying you mentioned it is already in testing phase between India and UAE. So what will be the value of that digital currency? Is it the same as the current fiat currency?
So, yeah, so digital currency is issued by Central Bank of UAE. So, it is backed by fiat instead of issuing fiat. So, what will happen, because this is wholesaled CBDC. Wholesale CBDC means, so they are going to help, let's suppose banks. Banks are settling with Indian banks. So, when banks wants to settle with Indian banks, instead of settling through their fiat currency, they will purchase this currency from central bank CBDC, and they will use this physical currency settled with. So, this settlement does not require involving central bank. Central bank will issue this. So, for example, you are Emirates NBD, you are bank Emirates NBD, and you want to settle with the State Bank of India in India. You go to Central Bank of UAE, you get these CBDC issued by central bank, and then use this currency to settle with the State Bank of India. So, it is at the pilot phase because wholesale, not retail yet. Retail will take time. I hope this answers your question.
Perfect. So does this have any impact in the future on SWIFT related payments also?
Oh, definitely, because what is SWIFT? Because SWIFT right now involved correspondent banks. SWIFT
Yes.
significantly rely on correspondent banks, number one. Number two, of course, they are messaging as well. But when it comes to CBDC, you do not need SWIFT. Now, how exactly SWIFT will be impacted, it's a question for the future. I cannot comment it now, maybe because of technology.
Okay.
SWIFT is also, because the reason I am telling you this, SWIFT, they are working on a blockchain platform. They have established a blockchain consortium, SWIFT already. You go and check on Google. So, if, and that's the reason, establishing blockchain consortium, because if it is there, then CBDC require blockchain. You cannot just
Okay.
push it somewhere, it requires blockchain.
Thank you.
Okay, so any other question? Otherwise, I'll move to the last part. Okay, there is a message, any participant facing a challenge in updating details like name, organization and email address. So, I'll send you an email at the end of this presentation. You can copy this email here, or maybe here one email is copied already, yasir@fimler.com. So, you can send your details. I know there is a technical issue, we will fix this matter later on, but you can send your personal details at yasir@fimler.com, and we will send you the certificate, digital copy of certificate at your email. So, my apologies for this inconvenience, but hopefully we will handle this. Last topic is Fintech discussion is incomplete without financial inclusion. Financial inclusion, financial inclusion is usually connected with poverty. When we talk about financial inclusion, it is somehow connected with poverty, means people are poor, they are unable to access financial services. They face challenges to access financial services. They cannot. And why they cannot? What is the reason why they cannot access financial services? So, I'll show you, I think there is one presentation, yeah, this slide. If you see this slide, this is 2017 data, almost 5 years old data, 4 years, 5 years old data. So, out of 7 billion population, if we say 7 billion, out of 7 billion, let's say 2017 it was 6 billion, I believe. So, 6 billion population, 1.7 billion adults lack an account. Now, 1.7 billion adults means in more or less almost every country, adults are allowed to open a bank account. 18 years or above, of 16 years or above. In some countries, if adult is considered as 15 years, then 15 years and above. I'm talking about those people only, but who are below adult age, I'm not counting those guys. They are out. So it means it's a significant population. 20-30% of 40% of total global population was unable to access financial services. It's a serious problem. It's a serious problem, definitely. So financial inclusion is providing an access to these people, not necessarily to open a bank account, but other financial services such as remittances, such as insurance, such as asset management. So I, while working with microfinance bank, I had the experience to see why people need and why should they need insurance. Why should they need insurance? They don't know do they need insurance or not, but do they need insurance? Yes. That's how we promoted. I think someone is joining. Sorry, just a second. This is Mohammad Ghazali. Okay. So insurance need, then remittances. Now remittances is a serious issue, serious challenge. I'll give you one example. Sub-Saharan Africa. Sub-Saharan Africa means the Central Africa mainly. That is not North. Now I'm not talking about Egypt, not talking about Algeria, Morocco. No, I'm talking about Nigeria. I'm talking about Tanzania. I'm talking about Kenya. These are all Sub-Saharan region. This region, the remittance cost of this region is 20% more than the rest of the world. Serious issue, expensive remittance. And if you are unable, because your family members are living outside in UAE, in other countries, they want to send you money. They unlimited money. They earn 2,000 dirhams, let's say. But what else? What exactly they get when they send money back to their home? 20% reduction, 30% reduction. So it's too expensive. Then transparency is another issue. So from here, the role of fintech comes in. What fintech does? Fintech facilitates financial access, whether it is your remittances, whether it is opening bank account, whether it is insurance, whether it is wealth management, saving, build an aptitude of saving, save money. So microfinance, I worked with Bill and Melinda Gates Foundation, where they helped us, they financed my bank to establish a saving account for their borrowers, to promote them, to educate them to start saving money. So inclusion is a serious problem, definitely. And if you see this data, World Bank data, 2023 data, 1.4 billion people still they cannot access bank accounts. 345 million SMEs globally, 345 million SMEs, they cannot access financial services. So there is a serious gap. But why there is a serious gap? Because regulators, central banks, and people rely, they want to rely on central banks, conventional banks, conventional financial institution. But things are changing now. If you see this table, in this table, you see the adoption globally, fintech adoption globally. China is at the top, 87% adoption, 87%, followed by India, 87%. And I'll give you one example of India. So I was speaking to one of my friend, he is an Indian, and we were discussing about how's your experience of buying chilies from, let's suppose, a small store somewhere. So he told me, we don't keep cash in India. We have QR code available on our mobile, everyone, mobile application. Even if you want to buy something of 1 Indian rupees, we have QR codes available. We pay digitally completely. And this is true, this is a very good indication, 87% adoption rate in India, fintech. So a very strong success story in China, in India, Russia. 400 digital banks in Russia operating, whatever the level of operations are. So it's definitely progressing very well. So the adoption rate is at the top now. Here, which industry adoption rate is high? For which activity, which category people really want to use fintech? Funds, money transfer and payments mainly. 2015 it was 18%, but 2015 it was 18%. 2019 within 4 years it reaches from 18% to 75%. And imagine COVID started 2020 or 21 I believe. So subsequent to that, I'm sure there is a significant change, 90% approximately. Then the second biggest product, fintech product where people want to use fintech is saving and investment, followed by budgeting and financial planning and insurance and borrowing. So this is an excellent adoption from fintech perspective. Why people want to use fintech? What is the reason? 66% people wants to use fintech because they think the functionality is excellent, top. They are very advanced, they are very agile, fintech. 55% believe 24/7 availability. Banks, even in UAE, banks close at 3. If I need my bank statement, after 3 I cannot go to bank. Fintech, all the 24/7 availability, 55% people believe. 53% people believe ease in setting up. In banks you go into a long queue, you fill documentation, fill forms, blah blah blah. Here you set up account quickly. 39% believe rates and fees are quite economical in fintech. So and trust is of course 31% as there as well. So there are few examples of fintech companies that are really contributing in financial inclusion. For example, if we take an example of Upstart, let's say. So credit rating, they provide very quick credit rating and loan. Then mortgage, better mortgage. Affirm, Affirm is credit card issuance company. They are issuing credit card. Typically in the past, if you have a bank account, then you can get a card, but now not anymore. So credit particularly, and then insurance. Zuna is money transfer company in Malawi. I worked with them. Zuna, very efficient, financial inclusion, progressing a lot. So these are some very good examples of financial inclusion. So basically what fintech is doing is they are bringing efficiencies in the process. So what I see 10 years, of course I cannot forecast exactly, but my reading is 10 years down the road, the contribution of conventional financial institutions such as banks, such as insurance, conventional I am talking about, I am not talking about insurance tech or digital banks, would be reduced to 30% or 35%, and rest all fintech, they will progress, they will perform. So yeah, I am going to take a pause here. That's the main content I want to discuss with you guys. Any question, any thoughts, anything you would like to share? We have the floor open. I can take the questions now before we progress to conclude the session. Yes, over to you guys. So usually there is a very common saying in training world. Number one is you are not asking question because you know everything. You don't need to ask anything, or second is you are not interested. So I cannot take an assumption that probably there could be another reason. But yeah, that's it from my side. If you have any question, any thought, you would like to connect, these are my contact details here. Our company is info@fimbler.com. That's our company email. One more email we have provided you here, that is yasir@fimbler.com. So you can send email to us as well, and we will share you a certificate, or if you have any query, definitely. You can contact me at my phone number, it's here, whenever you need. You can access our website. You can access my LinkedIn as well, LinkedIn profile. If you have any question, please feel free to drop me a message and happy to discuss. So before I close the training, last chance, if you have any question, any thoughts, please feel free to share. I am happy to take the questions or any thoughts. Otherwise, I will be able to close this session. Maybe let me see the setting side if there is no issue, if everyone is able to speak. I hope so, yeah. Yeah. So yeah, floor is yours. 1 minute and then we'll close.
Rashid, thank you very much for a lovely session. It was really amazing last 2.5 hours. So I just have one question. I mean, there like Atif here, there was some speculation in the market about GCC launching their own digital or virtual currency in terms of you can say coins or you can say in crypto. So you have any update about that one?
Atif, thank you so much. CBDC. So because see, virtual currency question is, do they need virtual currency? Because when you say GCC, so GCC means we are talking about 7 countries or GCC countries regulators or governments. That's probably the your ask is. Now government is not interested to launch their own virtual currency. They don't need it because virtual currency is anyways it is currency. It is currency. So the position governments took is to launch their CBDCs first, number 1, instead of virtual currency, to counter the impact of virtual currency, and of course there are multiple reasons. Then subsequent to that, progressing to have one central currency of the region. So globally there are different regions. They have, for example, UMEA region of Africa. I think they have 5-6 countries in UMEA region. They have one currency. Now, to be very honest, I dealt with the regulators of UMEA region, but I faced so many challenges with one standard currency. So it's easy to think about having one centralized currency, but unless you have a very strong infrastructure, financial infrastructure, one standard currency creates so many challenges and problems. So if GCC, because they are slowly and gradually progressing, for example, now they are progressing to have one standard Schengen type visa, let's suppose, one example, and there are some other facilities to public as well, expats. I hope at some point of time, the way they are progressing, they will move to one central currency. I hope so. Although I'm speaking to central bank, no one is discussing one central currency at the moment. But if they do, they can. It will be CBDC, not virtual currency. I hope this answers your question, Atif.
Thank you, Yasser. Sorry, thank you, Rashid.
Any last question before I move to the closure part? Nothing? Okay. So I think thank you so much, guys. I really enjoyed your presence here, and I understand because this is not a working day. Few of you guys are busy with families, etc. here and there. But personally, I really enjoyed the session because of presence of you guys there, at least to listen what my views about fintech is, and we will continue this program or similar programs in future. But I look forward to work with you guys, to connect with you guys through LinkedIn, through other platforms, through our platform Fimler, and we'll keep trying to exchange our experience later on. Thank you so much for your time, for your presence, and I wish you guys have a great day and have a great weekend. Thank you so much. Bye bye.
Thank you, Rashid. Thank you for your time.
Thank you. Thank you. Bye-bye.
Thank you.
Thank you, Rashid.
Thank you.